hopefully have finished microeconomics. Before you begin with this, I recommend you go back to Unit 1 of microeconomics, mainly because that same unit is also Unit 1 of macroeconomics. After you're back, you'll kind of understand the basics of what we're talking about here. With microeconomics, we were talking about small economic units. So when we're talking about those graphs, we're drawing corporations or firms. When we're talking about marginal utility and utility maximizing, we're talking about individuals. Those are all small economic units. In macroeconomics, we're going to be talking about big economic units. Things like countries, large corporations possibly, but mostly countries and governments. So first you want to understand how the economy is all connected. We kind of showed this using the circular flow model. The circular flow model is basically a simple way of understanding how everything is kind of connected. So we are households, businesses are corporations. The product market is kind of where you buy stuff. It's like your Walmart or Amazon or mall. A factor market is the factories that actually produce the goods. So we as households, we as individuals, generally we need to get a job to make some income. So that job provides labor that helps the factor market produce things. So our labor is the resources here that fuels the factor market. Then with our labor, the factor market produces a lot of different goods. These goods go to businesses. Businesses then give these goods to the product market, things like Walmart, Amazon, etc. And then the product market sells those goods to the households. It's a circular flow where everything is connected, where we provide labor to the factor market produces goods, businesses use those goods to give in the product market, and then we buy those goods in the product market. But we need money to actually buy those goods. That's another layer to the entire model. The factor market provides us income for our job here. We spend that money on goods in the product market. The product market gives money and revenue to businesses. Then businesses pay the factories for their goods. So not only is our labor a circular flow, but the way we earn money is a circular flow as well. Now this is a really simple model. However, you need to just basically understand the basic idea that the economy is connected through our labor, our money, and that it's all connected from businesses, households, the factor market, and the product market. What's not shown in this image is how the government is actually involved in all of this. So imagine a big government building, the Capitol building in the middle of all of this. The government taxes almost all of these. The government taxes the households, the businesses, the factor market, and the product market. So we have to pay a little bit more to the government. The government regulates businesses, and the government regulates everyone. They provide different things to households, like healthcare, education, roads, and many others, but they also tax and regulate. So the government can deal in all of this. They can reduce your income, they can reduce the labor to factor markets, they can influence all of this. So just understand the economy is connected and the government is kind of in the middle of all of it. So in this unit at least, we're going to be talking about the three main economic goals of every single government. First, they want to promote economic growth. Second, you want to limit unemployment. And then third, you want to limit inflation. If you don't know what any of this means, don't worry, we'll at least explain and learn what these means later on. So first, let's talk about economic growth. Economic growth is how our economy grows. It measures how much we're producing as a corporate country. So we measure the economy using GDP. GDP is also called gross domestic product. Gross domestic product, and you definitely want to learn this definition like word for word. Gross domestic product is the dollar value of all final goods and services produced in a country within a year. You want to remember this exact definition, because on the AP exam, there's a lot of different questions asking you about the definition of GDP in different situations. So you need to know it's all final goods, and it's all goods produced in 1 year. So GDP tells us how well or how big a country is doing in their economy. If a country has a low GDP, we know they're producing not that much. If a country has a high GDP, we know they're producing a lot. So now, how do we actually measure how our economy is growing? We measure that using GDP growth, how much the GDP grows every single year. GDP per capita is the way we measure quality of life, in macroeconomics at least. In reality, it's not perfect. However, for macroeconomics, remember, if there's ever a question dealing with the quality of life or how well people are living, it's the GDP per capita. What is the GDP per capita? The GDP per capita is the GDP divided by the population. So a higher GDP per capita means that one individual is going to produce more for the economy than another. So let's compare. The United States has about a GDP per capita of, I believe, $70,000 per person. Compare that to a country like, let's say, Pakistan of 1600. That means each American citizen is much, much, much more productive than the average Pakistani person. That means it kind of shows that the United States is more developed than Pakistan. So, GDP per capita, the higher it is, the more developed a country is. The lower it is, the least lower developed the nation is. So now we need to understand the three ways we can actually calculate GDP. Three main approaches of calculating GDP: the expenditures approach, the income approach, and then the value added approach. These two are very common, so we're going to cover them. The value added approach is a little less common, so we're not going to cover it for the sake of the video. However, if you have time or you learn it in class, that's great. So the expenditures approach is always this simple equation: C plus I plus G, X minus M. And you definitely want to learn this or memorize it because there's a lot of questions regarding this. The C stands for consumer spending. It's how much do consumers spend in the economy. I stands for total investment, so it's how much businesses invest in your economy. G is government spending, so it's how much the government is spending on stuff. And then the X minus M, this confuses a lot of people. This stands for net imports or exports. So the X stands for imports, M stands for exports. What you need to understand here is that net exports increase GDP, net imports decrease GDP. What net exports mean is that you're exporting, so you're basically moving products away from your country more than you're taking in. Net imports means you're taking in goods more than you're taking out. Net exports means that we're actually producing a lot more, that we're producing a lot of stuff and we're giving it away. Net imports means our GDP is kind of low, we're bringing stuff in. So the higher the net exports is, the more it increases GDP. The higher net imports is, the lower GDP goes. You need to remember this formula, and you need to understand how to calculate it. Then there's the income approach. This is a little less common, however you'll still probably see this. It adds up all the incomes earned in a country from producing goods and services. So first you have labor income, that's the income you earn from doing work. Rental income is your income earned by property. Interest income is the income you earn from loans, from businesses, and then the profit that corporations make. So you're going to see if you do see an income approach question, you'll see a graph or a chart that shows you labor, rental, interest, profit. It maybe show you something else, some sort of other income that's not on this slide right here. It might show you, let's say it shows you foreign investment income. Just remember, the income approach doesn't include that. It's just labor income, rental income, interest income, profit. The AP exam will try to trick you. It might add some different things. It's just these four: labor, rental, interest, profit. So now that we understand GDP, you need to understand the limitations of GDP. And these are incredibly important because there's a lot of questions regarding this. On the AP exam, it might ask you if GDP would increase or decrease, or if this type of transaction is included in GDP. You need to understand if that's actually applicable. So there's three main limitations you need to know. First, intermediate goods. That means that goods included into another final good do not count. What does that mean? It means that goods inside of another good don't really count. So if you produce a car and it has a radio inside of it, then the radio doesn't count. It's a part of the car. So intermediate goods don't really count. Second is non-production transactions. Remember, GDP is all about services and goods. It's what you produce for the economy. So things that don't really help the economy don't actually improve the GDP. For example, financial transactions, things like stocks, bonds, those don't increase GDP at all because nothing's being produced. You're just buying a piece of paper or you're buying a portion of a company. You're not producing anything. Same with used goods, buying or selling used cars or houses or whatever. Used goods don't increase GDP. Then finally, black market or illegal transactions. These don't count in GDP because the government or international organizations that measure and count GDP doesn't know what's going on in the black market. It's not regulated. So we just don't know how much it is. So it's not included in GDP. Now we're going to go to the second main goal in macroeconomics. It's controlling unemployment. Unemployment is the amount of workers looking for a job but aren't working. And you want to remember this definition. Just like the GDP definition, this comes up a lot in Unit 2. Unemployment is the amount of workers looking for a job but aren't working. The unemployment rate is the percent of people in the labor force who want a job but aren't working. So you have to be looking for a job, but you don't have a job. To be counted in the unemployment rate, there's 4 main requirements you need. First, you need to be 16 years or older, able and willing to work, not institutionalized, so that means you're not in jail or you're not hospitalized, and you're not in school, and you're not in the military. And that includes high school, college, etc. So you do want to memorize these 4 requirements because there is a lot of questions regarding this. So there's 3 main types of unemployment you do need to know. First is frictional unemployment. Frictional unemployment is temporary jobs or being between jobs. Let's say you're fired from Walmart and you're out for a job, but you're looking for a job and you might get a job later. That's frictional unemployment. You're in between jobs. Structural unemployment is not having the necessary skills or education for a job. Let's say you drop out of high school and now you can't work at a lot of different companies. That's structural unemployment. You don't have the necessary skills or qualifications for a lot of jobs. Cyclical unemployment is unemployment caused by a recession or bad economic times. So cyclical unemployment is basically when the economy is bad, so companies have to lay off, and thus you lose your job. Those are the 3 main types of unemployment you need to know. The natural rate of unemployment is frictional plus structural unemployment. That's because frictional and structural unemployment always exists. Both frictional and structural, they're always going to exist. Cyclical unemployment, not necessarily, because the economy could be booming. The economy could be doing great. And thus, we're not going to see unemployment caused by a bad recession. So, natural rate of unemployment, or it's called NRU, is just structural unemployment plus frictional unemployment. Now it's time to go to the last goal, which is controlling inflation. Inflation is the general increase in the cost of goods and services. The inflation rate is the percent changes in prices from year to year. So it's how much or how expensive goods are actually increasing. A price indice is an index number assigned to each year that shows how prices have changed relative to a specific base year. So let's just understand this briefly. Let's say that currently, last year, burgers were $5. The price indice would be 100. That's the base number. Then let's say that $5 burger increased in price to $10. That means it's a 200% increase. So the price indice increases from 100 to 200. It's simply a way to measure inflation and how high goods are actually increasing. The CPI measures the change in the cost of products that normal citizens and average people buy. So the CPI is basically normal goods you and me would buy. Things like milk, eggs, or possibly cars, or just a basket of goods that normal people would buy. So the way that you calculate it is the price in the market basket, which the question should give you, divided by the price of the base year, times 100. So what that means is you get the price currently divided by the price of the base year, so what year we're talking about, maybe 2023 or 2020, and then you multiply by 100 and you get the CPI. So now we have to understand the cost of inflation, because inflation benefits and also harms some people. For example, borrowers, when they're borrowing money, they're actually going to be benefited by inflation. Why is that? Because inflation means that your dollar amount is less valuable. So when you borrow money, it becomes easier to pay off your loans. So remember, borrowers are being benefited by inflation. However, to that end, lenders are harmed by inflation. That's because their income is fixed. When they give money to an individual, inflation harms them because that individual is being able to pay it off easier. So just remember, you don't need to understand the intricacies of it. However, just understand that borrowers are helped by inflation, lenders are harmed by inflation. We have two main types of inflation: cost push and demand pull. Cost push inflation is when the cost of raw resources increases due to a natural event or supply chain issues or anything else, that because of that increase in cost, products increase, which fuels inflation. We saw this in, I believe, 2020, 2021. Gas prices increased dramatically, and because gas prices increased dramatically, the cost of almost every good was more expensive because the way you produce goods is using gas. Demand pull inflation is when demand of a product increases dramatically, so the cost based on supply and demand model fuels inflation. Hopefully, most of you took microeconomics before macroeconomics. You would understand that when demand increases, the price of a good would also increase, if supply stays the same. So, if demand of a good increases dramatically, this can increase the cost because demand is up. Now we have to understand the difference between real and nominal GDP. Real GDP means that the GDP number is adjusted for inflation. It's adjusted for inflation, it deals with inflation. Nominal GDP means that the GDP number is not adjusted. Now this image deals with interest rates. However, the same thing can apply with GDP. The nominal GDP is going to be this thing. Then the real GDP is this, and it takes into account inflation. So let's say that the nominal GDP for 2020 was 1,000, and then let's say that inflation was 10% in 2020. The real GDP for 2020 would be $900 since it adjusts for inflation. So it's a way to just adjust the real GDP, the nominal GDP, to a real GDP. The GDP deflator measures the price of all goods produces. So you remember the CPI? The CPI measures goods that we as individuals, consumers, would buy. The GDP deflator measures inflation as a whole throughout the entire economy. The way you calculate the GDP deflator is nominal over real times 100. Why this? Because real GDP takes into account inflation. So when you take nominal divided by real, you get the real inflation rate. Then you multiply by 100 and you get the GDP deflator. Finally, the main concept you should understand is that our economy goes in cycles. It not only is connected, but it expands and decreases. You'll see four main terms that you might see: expansion, peak, recession, depression, and whatever this is, trough. Expansion is when the economy is growing very rapidly. During expansion, GDP growth is up, unemployment starts decreasing, inflation may be increasing or decreasing, it depends. Peak is the highest point an economy will reach. Then we start reaching a recession. A recession causes economic growth to decrease. Cyclical unemployment starts increasing. Unemployment rises because of that, and inflation can either increase or decrease. Depression is when it starts to get negative. Trough is the lowest point. Then recovery, you start to see an improvement, GDP up, unemployment down, expansion, peak. It's a cycle, it increases and decreases. So you need to understand expansion is growth, recession and depression are both decreases. So now you understand at least the basics of macroeconomics. This is basically the foundation. These three economic goals are the foundation of this unit. You need to understand economic growth, you need to understand employment, and then you have to understand inflation. If you understand these three, you'll understand most of this unit. Now, this is a very simplified slideshow. There's not a lot of stuff we didn't cover. For instance, with unemployment, with frictional unemployment, we didn't cover seasonal unemployment or unemployment caused by AI. There's a lot of different topics in this unit that we didn't cover. I just want to bring you a brief or simplified explanation of this unit. The best way to learn all the intricacies, if you want a 5 or an A in your class, is to do practice questions. Practice questions will not only help you build repetition and help you understand the AP exam, but it will also help you understand the concepts. It will help you understand what's going on in different terms and stuff that we didn't cover here today. So, in the link in the description, there's a practice set with, I believe, 10 to 15 different questions. Do those questions. Around 1 to 2 minutes is ideal for the AP exam, and then look through your answers and look at the answer key. Try to understand why you got every question wrong or why you got something right, and then understand the main terms you might not understand initially or might not be in the slideshow. Again, let me remind you, a lot of that practice a lot of questions on that practice quiz aren't in the slideshow because this is a really brief and summarized idea. However, if you understand the basic ideas of these three main economic goals, you should get every single question right.